Hope you're doing
Not live yet.
Now we are.
You know, we do this all the time. We think we're live and we're not.
I feel like I am.
Apparently we're live now. And then, of course, Wendy needs to turn her phone off.
Sorry, that was really rude.
We're very professional, as you know. Bill Fairman and Wendy Sweet of Carolina Capital Management, thank you so much for joining us this afternoon. Don't forget to subscribe, share, like. What else?
Twitter.
Definitely subscribe to the show. By the way, you guys can ask any questions you like. You just put it in the chat box. And if we have time, we will definitely go through those questions. We have a great guest today. Our friend Greg Hughes.
Mm-hmm.
He is from, and by the way, he's doing us a great favor being here because he's out in Nevada. So it's a little early in the morning for him.
It's not that early, Greg.
But he's in one of the great parts of Nevada where they actually have trees and grass.
That's
and
right.
He's in Reno.
And the early bird gets the worm. So he's got lots of worms.
So welcome to the show, Greg.
Thank you, guys. Yeah, good to be here. So yeah, how did you know how to say Nevada? Nobody says it right unless you live here.
Really? What do they say?
Everybody says Nevada.
Oh.
And we say, no, it's not Nevada. It's Nevada. So, congratulations, you guys. 3,000 miles away, you know how to say it.
I think he gets 5 points for that.
We are world travelers.
Yeah.
Yeah, you guys are pretty big time.
I've been to Puerto Rico. I'm a world traveler.
Yeah.
Yeah.
So we're focusing on you, obviously.
Since you're the only one here.
That would be helpful.
Yeah.
So you're a turnkey provider, and you have a opportunity for people that can, and we'll explain what a turnkey provider is. But why don't you give us a little background on how you got started and what it is you do and where you do it and all that good stuff.
All right. So we're based out of Reno, Nevada. Yes, we have trees here, which is pretty cool. High desert, so it's hot sometimes during the day, but always cools down at night with everything. But you know, I've been in the business now for 11 years, and the way I got into this is prior to that, I had met a friend. Well, I had a friend, and he had. Boy, this is going to be rough, isn't it? But we started doing hard money lending. So that's how I knew about that. And in 2007, we started the business when everything was crazy and we were doing all vacant land. And in that little short period of time, 18 months, we raised $65 million because, you know, real estate couldn't go bad, right? And then we all know what happened. So at that point, things started to melt down. Him and I didn't see really eye to eye. And so I had built a fund for him just before we had left. First time ever, you know, spent the time with the attorneys doing all that. And then went to start Hughes Private Capital. And so, but part of that was I was an investor in most of the things that we were doing. So I was always putting money in and being an investor. And you learn a real fast lesson that vacant land does not produce you any money. In fact, it's just an expense, right? Mm. So, and one of the pieces of vacant land, which was 21.5 acres up by Squaw Valley, very famous ski resort, very, very high end stuff, was one of them that we took over. And I say we because my partner, Steve Sixberry, was an investor in there as well. And so we ended up taking that over and having to foreclose on it and taking it back. But we had 65 other investors that were in there. And that took 6 years of our life to do that.
Wow.
And, you know, at the time it was appraised at $37 million. And when everything melted down, people were offering us about $4.5 million. We had lent $11 million. So one of the lessons that we learned from that was, we really don't want to do this sort of stuff on vacant land, you know. So we started a different fund, which was all about doing lease to owns, and we did it in Reno and we did it in Las Vegas. But we always stayed in what we call the kind of the affordable housing, the core rental market. And then that just grew from there. That was our first fund. That fund's still going today, but it's not. We don't take any new investors into that. And then so lots of things happened over the 11 years, and we did different types of stuff. But in the last it's been almost 4 years now, we started buying homes in the Midwest. And what we really, really like is those homes don't go up and down in value a whole lot, which sounds sort of funny because you're buying real estate and you always think of appreciation, but it also doesn't get hit like we got hit. Say here in Reno, I mean, some places, and especially Vegas too, you might have lost 50 to 60% of the value of what you bought, right? So that's how we got started doing all of that. And Steve, who was an investor at the time, and they helped me to get rid of that other piece of property with our other investors, became my partner, and then that's how we started doing what we're doing today.
Excellent. I do love the Midwest because of just what you were talking about, is that values don't go up very quickly.
Right.
They don't go down very quickly either. You're not really looking at these properties for appreciation. You're looking at them for cash flow.
Yeah.
And that seems to be the sweet spot there in the parts of the Southeast, I believe as well. How difficult is it for you to manage those properties from where you're located?
Well, they're just 1,500 miles away. No problem at all. Sometimes they need something, so I drive out there, and
clog a toilet.
Yeah. Well, so we buy the houses, right, and we rehab them, and so we try to bring them up to a pretty high standard. But these are the affordable homes. So out there, we're buying homes in the $75,000, $125,000 range or so. Again, you always learn lessons, and sometimes the lessons come harder and easier to you depending on how it goes. But today we've got about 780 homes in the portfolio. By the time we hit about 300 is the time that we started to put our own people on the ground out there. So as of today, we've got a little bit over 60 people that are full-time employees with us on our team. And 20 of those are out in the Midwest area. So we're in 3 cities in Ohio. So it's Cleveland, Akron, and Toledo. And then we're also in St. Louis and Birmingham. So those are the main 5 cities. But we had to hit an economy of scale to sort of be able to afford to put our own people on the ground out there. So we have now in each one of those cities, we have our own real estate brokerage, our own property management, and our own construction management. And that's night or day. And it's really the difference between being successful or I could say failing, because literally before we were doing that, it's a tough deal to rely on third party, especially property managers. Hate to throw them under the bus, but it's just, I think everybody's got their stories, right? On all that stuff, and it's just a really tough deal. So that's how we end up managing. So the other, 35 or so people that are on our team are here in Reno. They do lots and lots of stuff from Reno, but we always have the people on the ground when we need them, and be able to actually, make all that stuff happen. So yeah,
you have acquisition people in both places, like in Birmingham and in the Ohio area. Do you have acquisition people there, or are they all working out of the Reno office?
Well, most of the acquisition people, what we would call our acquisition people, are in Reno, but they're always utilizing our team members that are, on the ground there.
Right.
Because obviously we got to be able to see the properties. We've got to be able to figure out what the rehab is going to cost us before we buy it, and all of that. So again, what we're really looking towards doing is building a very sustainable model. You know what a BHAG is?
Mm-hmm.
A big, hairy, audacious goal, right? And our BHAG is 23,000 homes. So that's a lot of homes, but it's doable. It'll take time. And in some respects, it doesn't matter whether we get there or not. But what we do want to do is be able to build it so that we have, into the thousands of homes, because that becomes very sustainable type of business model that, no matter what, we can always be managing those. And if you are doing nothing else, you have enough homes under management that pays the bills for taking care of that. And we think very long term with this fund, because it is a buy and hold. And so we're talking 20, 30, 40 years in the future. There's no plan to turn around and sell these properties because they just keep producing, right? People say, well, won't the houses get old? I'm like, they're old now. So they're already 100 years old. Throw an extra 30 years on them, they're still going to look just as good, So yeah.
How do you choose the areas that you go into? What are some of the what are some of the guidelines in an area that would pique your interest in that particular market?
Well, we call it a rental matrix. Is really, it's probably not really what it is, but that's what we call it. And so it's really our buy box is what it is. So we're looking, and it's a simple deal, right? You're just looking to say, okay, I can buy the property for this, I can rehab it for this, and I can rent it for this. And then, taking into all the consideration whether you're paying for sewer or it's part of, this or that, or, et cetera, et cetera. And then we're looking for a yield. And by the time we're done, we want to be able to have a yield to our investors of somewhere between about 7 to 9% before the depreciation side of it. And that's a way that we put everything together on looking at that. So, those properties, again, in the Midwest, you can't do that here in Reno. You can't, I get a little bit better than 1% of rent than compared to the value of the property. Sometimes more than that, depending on the value of the property. In Reno here, where we would get not 1%, we get maybe 0.5%.
Wow.
We would probably be break even, and we wouldn't have any cash flow. And then you just bet in the farm on appreciation, which, a lot of times that pays off. But, you also got to be smart enough to figure out exactly when to buy and when to sell. And that's the other thing I think people always miss with appreciation. Maybe you can kind of figure out when to buy and do a lot of that stuff. But who's to say when you're going to sell it is the right time? You might be forced to sell it at a certain time. So, we'll get appreciation on these homes in the Midwest, but it's a little tiny bit. It's 2%, maybe 3%. But you got to hold them for a long time too,
Sure.
because they just don't. They don't have those big. Well, they don't have that volatility. I guess is. And it's so funny because 10 years ago, 11 years ago, maybe all of us would have said, "There's no volatility." There is.
That's so funny because what you're referring to, I call it. Thanks. To kill me there, bro.
Have I been that inspirational for you? You're that choked up, Wendy. I love it.
He just wanted to hit me, is what it was. So, I call that gravy or the cherry on top. And I tell people never, never, never buy a house for the gravy or the cherry on top. It has to stand on its own. Like you're talking about with the revenue that it's bringing in. And I'm just curious, are you looking at the employment in the area, what the median income is, the cost of living? Do all of those things make a difference for you when you choose an area to go to?
They do. You're always looking at that. Your main thing really is to know that not only can you hit the numbers that we talked about, but you have the demand, right? It doesn't do you any good to get the property and then not have the demand for the rental side of it.
Right.
So we're always looking at all that stuff. We also, every city you're in, you're buying in multiple neighborhoods. And then, of course, being in the 5 cities really helps us to have that diversification, because I actually do think that's probably the biggest risk that we run, is that one or more of certain neighborhoods just lose the demand, right? An employer leaves that really is instrumental or something like that. And it's just hard then to rent those properties out. You'll have to drop your pricing and do all of that. But, that's another thing that we do is you look at we call it the stress test, right? You stress test what's going on, which is super easy. All you do is if you're getting $850 today, you say, well, what happens if I can't do that, right? If I can only get 600, what's that look like? And, usually when we run those numbers, you can be anywhere from, believe it or not, 20 to almost 50% less rent and just hit the break-even point. So, there's a lot of room in there. Now that drops your return down, but you're at least not losing money. And if you're not forced to sell the properties, hopefully that neighborhood will start to come back or whatever.
Right.
And you can just hold on to them. So that's part of it. So, yeah.
Right.
So Don Harris has a question for you, and I think you may have covered it earlier. How many doors do you have now?
We have 780, and we're bringing on between about 40 to 50 more each month is what we're doing. Yeah.
Excellent.
That's not bad.
So we talked about scaling earlier anyway. So a lot of people in this industry choose multifamily properties because it is a little better to manage a lot under one roof versus, kind of being spread out in single family. Or is there positives and negatives to that? I know the values of each door are going to be higher in single family, but does the rent that do the rents offset a little bit of extra expense of being spread out?
Yeah, sometimes we're accused of always doing things the hard way, and I think that accusation's pretty accurate. Sometimes I do wonder about that, and but I guess the other side of that really is we talk a lot of times about efficiencies and inefficiencies, but within the market, right? So in other words, the stock market is a very efficient market, very difficult to outperform other people that are in there. Then you go to the kind of the alternative investment market that we're all in, right? And there's a lot of inefficiencies there. And that's what gives us a leg up on a lot of things. But then even within that market, what can you do to be, something that is less competition? And that is partly why we're going that direction. There's a lot more competition on the multifamily side of the business with obviously very, very large players
Right.
That are out there. Doesn't mean you can't be really successful and work that. And, maybe someday that's something we'll do too. But as of right now, we really like the single family. The other thing is just kind of interesting because you don't think about this quite as much, but with everything that happened with COVID and people having to hunker down, you hear about some people actually leaving apartments and trying to get into single family homes to just, because of that problem. Now, this is probably all temporary, or let's hope it is. But that's another thing. There's nothing like having your own home. So, and I think sometimes you get a little bit different tenants and all that sort of stuff. But it ended up being a place that we started to go down the path, and we really liked it, and we liked what we saw, and we just see a little bit less volatility in there as well. But it's a lot more to manage. There's no doubt. It takes more.
Yeah, the reason I bring that up, and that was, back in 2011, 2012, I guess.
The good days.
The big hedge funds came in and started buying up all the single family foreclosures in the suburbs. They started paying way too much for them. So the individual fix and flippers or the buy and hold people, they kind of stepped back and said, I can't compete with this. I'm going to have to go into another area, because they were paying way more than they should have for them. And, in the back of my mind, I'm going, all right, so they're paying too much. And now they're going to have these extra costs of managing far-flung empires, as it were. And I said, there's no way this is a good model. Well, I was completely wrong. Number one,
go figure.
their cost of capital was pretty low. At the same time, there was a huge appreciation in these areas that they went into.
Yeah.
So now they're sitting on property that's worth a ton, And the timing right now is great for. First of all, there's not enough single family housing out there. The demand is very high,
especially in the affordable arena.
And if you look, and this happens all the time because it's very cyclical. Multifamily will be low. There's demand. They don't have enough properties. Then they build like crazy, and then they oversupply the markets, and then they're competing with each other because they've got all these empty apartments.
Right.
We're in a position right now where there's an oversupply of multifamily in most markets, especially if you're in a larger market, because again, people are trying to get out of the apartments now because of the COVID. And so you're going to see a bunch of A-type properties or A-class properties, and their rents are going to be now the B and the B plus rents.
Yeah.
So that's just going to trickle down and hurt everybody else down below. So I like the single family. I was just going to try and get your perspectives on it. Perspective. Geez, easy for me to say. But that, it is a great market. It's more stable. And you're right. There's fewer people in it because they don't want the hassles that we just talked about.
Right. Greg, too, I love that you are in the buy and hold arena. You were on the Freedom Founders call on the meeting we just had when we had the opportunity to listen to Dan Kennedy, the legend, just share his wisdom with us. And one of the things he really, really harped on was turning your income into wealth, that it's really important that we do that. And you do that through buy and hold property. It's the best way to make that happen. So what I really want to get into a little bit more about is your financing, how you have your fund set up. How is it that somebody raises $65 million? I want to know, how is it that what positions do people play that are in your financing arena? Tell us how that works.
Well, that's kind of interesting. I think maybe what we should do is, and just so you know, the 65 million was back in 2007, right? Yeah. So let me give you a little bit more background on our stuff. So we run a real estate investment fund, okay? And it's actually, the name of it's called Guardian, but Guardian, the life insurance company, sent us a letter saying you can't use that name. They're 100 years older than we are. We said, and the letter came from a New York attorney. So we said, okay, we'll call it the buy and hold fund, okay? So we don't use that in. It's still called Guardian, but that's just on the backside. It's a buy and hold fund, okay? So the buy and hold fund's got about 25 million or so of properties inside of it. But we have another 20 million on top of that. So what we do is, so the buy and hold fund is it's pretty straightforward, right? I mean, we buy houses, we put them into the fund, and that's where they sit. Investors, right now the buy and hold fund's paying about 8.5%. Plus you'll get the depreciation, so you might get another 1.5%, on your return. But the other thing that we do a lot of is what we call a secured portfolio. And you can do a secured portfolio a couple different ways. Now, you guys call them turnkey. We don't use the word turnkey because we do it so differently with this sort of stuff. But say somebody wants to come in and they want to finance. So this is going to go a little bit your direction, but it's more with the individual. They want to finance the properties. So what we would do is we would sell them a property out of the fund, or multiple properties. Most of the time it's multiple. People can get a beautiful Fannie Mae 30-year 4% loan today on these properties, but you can get 10 of those per person. So if you're married, you might be able to get 20 if your spouse qualifies. So they come in, we would, let's just say we're going to sell them 8 properties. We're going to sell them 8 properties. They get the financing on it. And most of the time what we find is we try to do it on a kind of conservative basis, basically about for every dollar they're going to put in, they can buy $3 worth of property on the deal. And then once they get the financing done, what we do is we actually lease the property back from them. And so we take over all the responsibility on those properties. And so the only thing they have as an expense is the ownership insurance. Other than that, what we're going to do is pay them a set monthly income on that property. And then we're going to take over everything else. So if the property is vacant, it doesn't matter to them. We're still going to pay them that set monthly income. If we got to fix a hot water heater, we go out, we fix it, we pay for it, and that's the deal. Because we've leased that property back from them. And then, of course, we have a tenant in there that's paying the rent on that. So then that part goes into that other side of the portfolio, not in the fund, but in what we call a secured portfolio. And we call it secured because their name's actually on the title of those properties. And then we just manage all of those. And then another big piece of all of that is that we do 1031 exchanges. So somebody wants to sell an investment piece of property, not want to pay any taxes, which we pretty much all want to do. And they come in and do the exact same thing. So they've sold a property for $1 million. They come in, we get them X amount of homes. If we're going to do some financing, we'll do the financing, and then we lease those properties back. And then those all go back into the portfolio. So that 780 homes is the entire portfolio. And that's what sort of gives us all the consistency of the return, but also the safety too, as well, because we're very well diversified in geographical areas and everything else on that. So that gives you kind of a background of the way that we work all of that. Now, from a financing standpoint, it's actually really kind of hard for us to get financing for the fund, because that's where we would be getting the financing. The other financing is just happening with the individuals. And when the individuals go get the financing, this is kind of an interesting thing, because we know that that part of the financing is so cheap today, right? Is they can usually increase their return by about double. So they're going to make anywhere from 12 to 16% return on those homes, and they're not going to have any landlord hassles or anything else that come along with that. So from our standpoint, it's always been a challenge, because we're sort of that strange in between when we buy lots of single family homes. And we actually did this with our first fund. And I'll even go back to that one for a few minutes. We probably went through 100 banks to try to get financing, because we needed longer term financing at a lower price, because compared to what you guys do, you're more short term.
Right.
Perfect sense. Like if I'm flipping or doing something like that, that makes perfect sense. But for us, we had to look for more long term. And then we would be put into sort of the residential part of the bank, but then really the commercial part of the bank. And they never knew what to do with us. And so over the period of time, we end up using a one company called 5 Arch, who wasn't a bank, but kind of, I always call them private equity. And then 5 Arch, as you guys probably know, got bought or acquired, whatever it is, from Corvest. And so from our perspective, that's where we've gone. Now, those terms are never as good for us. We just did about a $3 million deal with them, and we got it at 5.9%, I think. But that's not even, that's okay. I mean, that works pretty good for us. That can help to increase our return. The bad part is it's only a 10-year loan. It's amortized over 30 years. And we were able to actually, for us, because we're cash flow, we were able to get the interest only on that, which is great. But then it has a 6.5-year prepayment penalty. And so, so there's some commitments going into that. And at the same time, I don't know what, I know 10 years is a long time, but we also know it's not very long.
Right.
What does 10 years look like, right?
Murphy's Law is that when you have to refinance, you're not going to qualify.
Exactly. Yeah.
So
it's always the same thing. When you need the money, nobody wants to give it to you.
That's right.
Same old stuff. So, yeah.
So I know this is kind of in the weeds for fund managers here for us, but are you the pieces that you're selling off, are you putting that part of the portfolio in a special purpose vehicle, or is it just a separate entity, but it all works together as a group?
Yeah, it's not even a separate entity, because what ends up happening is those homes are titled in the people's names. So, and that's required with the 1031s anyways.
Right.
Sure.
That's actually how we got going on that part of it, because we started trying to figure out how to do the 1031s. So we don't really end up putting those into a separate entity. So you have the fund as one, right? And then all those are just basically leased back from each one of those investors.
You're the master leaseholder.
Yes, exactly. We do a master lease. That's right.
Okay.
Yeah.
All right. Yeah. Well, that makes sense. And that gives people that want the peace of mind of having a deed of trust or a mortgage or ownership if they pay cash versus being in a fund. You still, and this is the beauty of your fund as well, is that you still get depreciation, because when you're in a fund, you own the assets in the fund, your percentage of them. And so the properties still get depreciated either way, and you still get the same tax benefits of being in the fund or not. So on the fund side, it's an open-ended evergreen fund, I'm assuming?
It is. Yeah, exactly.
So is it an accounting nightmare for you to have people going in and out at different times and figuring out what their equity and stuff would be at the time they exit?
Oh, Bill, you're throwing in that's a really big question. that has been what would I say, debated for the last 11 years since we've been open as a company, because even our first fund kind of fell into that. And so and it really, the answer to that is probably more than what we can really cover here.
Sure.
Because you're talking about setting or striking a net asset value for all of it. There's no way we could do that. Now, just think of 780 homes. Right?
I just can't imagine.
Yeah. Okay. And Joe wants to get out of the fund. So let's go appraise all 780 homes, right? And by the time you get done, you got to start again, because, it took so long. You know where I'm going with it. Yeah. So we just look at it from a cash flow standpoint. And again, since it's such a long-term deal, at some point down the road, probably it will dismantle and you will sell off either pieces or all of it at some point. But it's just not a really easy thing to do to strike that NAV. But yes. Well, so I don't know how well I answered that question.
No, you did. That was clear as mud.
It's just
right.
we're simple folk over here. So that
well, stop asking the hard questions.
A lot of people will do a closed-end fund when they own property just to make it easier on the side, and then do the open-ended funds when you're doing lending, because it's easy. Right. There is no value unless you made a poor decision and now you own some property. and that happens. And sometimes it's not a poor decision. It's just things happen.
Yeah.
Right?
Exactly.
Listen, that's a great opportunity. There are a lot of funds that own property in it that you have to keep your money in for a certain period of time, and you don't get the benefit of your payout until the end of that period. Right. And so while you may not get the same type of equity play in a closed-end fund, at least you're able to go in and out and be able to get money right away and start earning. And you can't do that in those closed-end funds. So
right, they all kind of play a different role. And that's one thing we didn't mention, is that within 90 days, or if you want to get dollars out of our fund, you just give us a 90-day notice, and then we'll get the dollars out. So, that's a big difference too. What's that, Bill?
What I meant by that was you're getting cash flow right away, and a lot of times
you're getting cash flow too.
You're not getting a whole lot of cash flow.
Right.
You're kind of waiting until the
payoff.
Yeah, some sort of action takes place. It's either a value add, say for an apartment complex where you're going to refinance and pay your investors out that way, or your value add where you're going to sell it, and that's where the payoff comes in. At least with this, it's ongoing cash flow when you get in. So
I really love the way you have taken this and turned it into a great option for 1031, because we get calls all the time, people that are just in a hurry to try to identify properties and get that 1031 taken care of within the time frame that they have to do it. That you're like shooting fish in the barrel with that, because it's just perfect. I mean, look, if you're getting 40 new houses a month, look what they have to choose from. It's just amazing that, I mean, anybody who has a 1031 exchange to do, I wouldn't think twice about, picking up the phone and saying, "Hey, Greg, what you got?"
So your list consists of, and I'll say Rolodex, but nobody has those anymore. Your list is probably full of a bunch of 1031 exchange administrators, right?
Well, it is partially, believe it or not, too, Bill, we just started our own 1031 company as well.
Oh, nice.
Wow.
Yeah, figured that would actually, really work into the whole mix. So, yeah. But we really use one 1031 company here in Reno until we're just now getting our own started for the most part. But most of the people find us not through the 1031 companies. They find us through mainly our marketing and, the things that we put out there, or, referrals and all that sort of stuff. But let's talk the 1031s just for a second, because I do think this is always an interesting thing.
Sure.
We solve a real problem. So here's the problem that we see happen, or here's the challenge, whatever you want to call it, that we see happen all the time. Somebody has owned a piece of property for a long time, right? I mean, they bought it 20, 30, 40 years ago, maybe even inherited it, whatever. But they have been there and they have done that, type of deal. And they're so sick of it. They don't want to be traveling. They want to be enjoying their life. They don't want to be getting phone calls on whatever it is, on any of that sort of stuff. But they don't want to sell it and pay all the taxes, because they've gained all these capital gains. They have all this depreciation to recapture. And so they sort of feel like they're stuck. And what we do is able to solve that for them. So, because on top of that, they've got all this equity, we call it trapped equity, inside those properties, and it's not working like it should for them.
Right.
So what ends up happening is, if they sell that property, do the 1031 exchange, for us it's super easy because we sit on millions of dollars of these properties, so we can identify them within, literally we could do it in a day. And then what's so interesting is, not only do they get rid of all their landlord hassles, but they usually double or more their net income that they were making, because all of that trapped equity was in their investment property before.
Nice.
So, it's like, it's always the old deal of, it sounds too good to be true, but we do this every day, right?
Right.
So it really does solve that problem for people if they're kind of done with it but don't want to pay those taxes and move on.
And the benefit to that is I don't have to pay the taxes on this. Let the kids worry about it when they inherit it.
Yeah, and when the kids inherit it, they get the stepped up basis. So if you're really smart, you'll leave your real estate right in your estate, and you never pay taxes.
Right.
So, yeah.
Well, we are getting close to the wrapping this thing up. Greg, tell people how they can get a hold of you for the fund, or if they wanted to do the, we'll call it a sale leaseback.
A sale leaseback, yes. All right. Well, certainly you can go onto our website, which is, there you go. It's up on the screen, hughescapital.com. That's one way. My email address is greg@hughescapital.com. And telephone number to call us is 775-234-4001. So those are all the ways to get in touch with us. So we'd love to talk to anybody.
Well, we'll have that in the notes
Thank
as well.
you. Thank you so much.
So, folks, I hope you enjoyed this. Greg is like a hybrid, and we're not going to call it a turnkey anymore.
Well, let us say this too. We've known Greg for a while now. He's in another group with us, and yeah, that's right. He's a great guy. He does what he says he's going to do. He's honest as the day is long.
Even though he lives in
Reno,
Nevada.
Yeah, don't hold that against him. Nevada. He's a we know, like, and trust him. We say that all the time. He's a good egg. So that's our referral.
All right. So
thanks so much, Greg.
Quickly,
thank you guys too.
We are Carolina Capital Management. Our website is carolinahardmoney.com. Please don't forget to share, like, and subscribe to the show.
Mm-hmm.
And if you have a few more minutes coming up, we're going to be doing our panel, and Greg is going to join
He'll
us
be back
for that at top of the 1 o'clock
So it'll be
hour.
Greg Hughes 2.0.
That's right. Thanks, everyone. Have a great day.
Thank you.